Good morning. We will spend time on the repurchase of shares by a company today. A company might decide to reduce its ordinary share capital because they are not using all the capital and to buy back shares from existing shareholders. So that means that some of the shares that were sold to shareholders will be repurchased by the company. According to the different textbooks, there are 3 different methods to record the buyback of shares, but the following method is the one that's recommended by the Education Department, and it is also the easiest method to record these entries. If we look at the question, Cullinan Limited is registered with an authorized share capital of 1 million shares. So the authorized share capital is 1 million shares. Remember, the authorized share capital is not the shares that were sold. That is the maximum number of shares that the company is allowed to sell. The retained income is the profits that the company kept back in the business that they didn't pay out to the shareholders in the form of dividends. So at the beginning of the financial year, this retained income was 128,909. You must remember that this retained income actually belongs to the shareholders. The company just kept it back to use for expansion or as security for the future if they need money. So the ordinary share capital and the retained income together will form the equity of the business. The Cullinan Limited originally issued 500,000 ordinary shares at R5 each. So that means the share capital account will have this 500,000 times 5, 2.5 million rand in the capital account as a balance. At the end of the year, on 30 June 2015, they decide to buy back 100,000 ordinary shares at the original issue price of R5 each. That means that they are going to repurchase these shares from the shareholders. The shares will not belong to the shareholders anymore. They will be paid out the 500,000 that they provided as capital when they bought the shares. If we look at the ordinary share capital account, you will see that the balance there is 2.5 million rand. That was the shares that was originally sold, 500,000 times 5. So that was the capital that was provided by the shareholders. When they decide to buy back some of these shares, it means that this capital will now decrease, so the equity of the business will decrease on the debit side. And you will show that the bank is credited and ordinary share capital account will be debited with the 500,000 that's repaid to the shareholders. When we work out the balancing figure now, the capital actually reduced from 2.5 million to 2 million rand. And the number of shares that was issued was 500,000. The repurchase was 100,000. So the number of shares in issue reduced from 500,000 to 400,000. If we look at the note that to the financial statements for ordinary share capital, we will show the authorized share capital is 1 million ordinary shares. How many of these shares were issued at the beginning of the year? 500,000 was my opening balance, and that was worth 2.5 million rand. No shares were issued during the year. At the end of the year, 100,000 shares were repurchased at the original R5 that it was sold for, so the capital decreased with 500,000 rand. And your closing in ordinary shares will then be 400,000 ordinary shares with a capital value of 2 million rand. In the retained income account, you will show that the opening balance is 128,909. Because the shares were repurchased at the same price that it was originally sold, no money will be used out of the retained income for the repurchase of the shares. As long as it is the same price that you originally sold it for, it will just reduce your ordinary share capital. What did we learn today? The issue share capital can be reduced when the company decides to repurchase shares from shareholders. That means the capital balance will reduce with the amount of money that's repaid to them, and the number of issued shares will be reduced.